Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Rene Reyna. He is the head of Thematic and Specialty Product Strategy at Invesco to discuss considering defensive allocations for portfolios. Rene, it's great to see you as always. Welcome back to Trade Talks.
Thanks, Joe. Happy to be here.
You got it. And in considering this environment, why should investors consider a defensive allocation in their portfolios?
Yeah, so I mean, there's three primary factors I think right now that are concerning investors. I think one is the inflation and interest rate environment is going to continue to drive the market. So today, the Fed did meet. It they did raise the interest rates 25 basis points. It does appear that perhaps they may take a pause, but even having said that, they've made it clear that they're going to be data dependent. So perhaps it will just be that. So not sure if tightening is over quite yet. So I think that's one sort of looming concern in the marketplace. I think two, the U.S. debt ceiling, potential failure to reach a debt deal can create a lot of shocks in the market. We've seen that happen historically. So I know that's certainly weighing on investors' mind. And really the third sort of component that we're starting to get additional clarity on is around banks. So will other banks fail? Contagion fears have not come to pass quite yet. It does still remain a concern, and we're sort of taking a look in the backdrop to see sort of what happens next. So I think all in all, those three factors really are causing investors to perhaps be a little more defensive than typical sort of risk on markets.
What should investors know about the consumer staples sector?
Yeah, so the consumer staples sector, I would consider a more defensive one. Number one, so like if you think about the defensive space, generally you're going to think about food and beverages, energy drinks, so all the things we need as consumers and things that we, in some cases want, so that could be cleaning supplies, cereal, tobacco as an example, razors. So there's all of these different goods and services. This can also include supermarkets and convenience stores. So this theme is an area where you generally continue to see demand, and therefore you see price stability, if you will. Now, when we look at this particular space, I think one thing we also recognize in past economic, let's call it down phases, these products tend to hold up better. These are companies or businesses and products that we have to buy. These types of companies generally pass on prices to consumers. We've seen earnings reports come out and it's kind of played out that way. Think of the Pepsis and the Cokes of the world, for example. So this space tends to be more reliable. There tends to be less variability, and the trade-off is you generally get less growth in this space. Now, we've seen consumer staples do relatively well in 2022, so that kind of played out. We've seen it a little bit play out this year. I mean, if we just look at the consumer staples sector, you generally see returns on average. If we just look at various, broad indices, anywhere from 4 to 8%. And for investors who are just using the S&P 500 as sort of broad market exposure, consumer staples represent about 7.5%. And so when we look at sort of like a return contribution, the S&P 500 is up, 7.8% year to date through yesterday's close, and that 7% consumer staples component of the S&P has only contributed about 0.32% of that return. So the point is even though you get some exposure in consumer staples, if you own the broad market, it's having not much of a meaningful impact. And so I think really the thought is perhaps investors should consider adding exposure, if they really want to sort of include that reliability or stability, let's call it, that consumer staples can provide to a portfolio.
Is there an example of an Invesco ETF that provides investors exposure to the consumer staples space?
Yeah, so at Invesco, we got a variety of options. I think the one that I will talk about today is our Invesco Dorsey Wright Consumer Staples Momentum ETF. This tracks a Nasdaq Dorsey Wright Consumer Staples Index. And I think what's interesting about this particular ETF, because again, there's a variety of options you can get consumer staples exposure to, but this strategy employs Dorsey Wright's momentum sort of point and figure approach. And so effectively, they're using the underlying fund methodology, rules-based methodology, is using technical factors, a Dorsey-Wright scoring system where they look at momentum. And so what happens on a quarterly basis is the fund takes a look at the consumer staples universe. It looks at relative strength scores. It ranks the companies based on their relative strength. And so the top 30 are selected. And then that process is, last thing is we weight it based on that relative strength. So you're ensuring that the highest component is sort of the strongest security based on momentum in the fund. And then that process is repeated every quarter. So the ticker is PSL. It's about 162 million in size, and it's a very sort of differentiated approach to get exposure to the consumer staples sector. If I look at from performance, just kind of what we've seen, because the methodology is targeting companies that have momentum, you'll see the weight, for example, whether it's beverage companies, whether it's more of your supermarket or convenience stores, you'll see variability from quarter to quarter to ensure that it's maximizing that momentum. And we look at return analysis just year to date. We've seen returns about 8% in our particular fund versus sort of the broad consumer staples index, up about 4 to 5%. So you're seeing some outperformance currently in this particular space. So nonetheless, just an interesting way for investors to get exposure to the consumer staples theme.
All right, Rene, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.